On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Great to be back and fully into the swing of things again. Let's take a look back at last week across financial markets, then let's turn our attention to the week ahead. It was a good week for most global share markets. The US S&P 500 was up 1.7%. That sees it up 3.7% so far in January with a week to go. It's actually been the best start to a presidential term since Ronald Reagan's second inauguration back in 1985. Most other share markets are up to start the year. The Aussie market's up 3%, UK shares up 4%, Europe up 5%, emerging markets sort of sideways up just 0.5%. Japan, the only major market that is down so far this year. Very much early days, but the Japanese market is down 1.2%. Local shares also off a little bit this year. The NZX 50 index was down 0.8% last week, and to start this year we are down 0.7%. However, remember that we did have a very strong second half of 2024. The NZX 50 rose 11.9% in the second 6 months of last year, so it had a very good run over the back end of last year. From here on, we might need to see some more evidence that the economy is improving, and that will happen, but it won't happen overnight. So things are a little bit subdued on the local front at the moment. Interest rate markets, US interest rates were little changed last week. The 10-year Treasury yield finished the week at 4.61. That's not too far from where it was a week earlier. It actually hit 4.81% earlier in the month, the US 10-year Treasury yield, and that was the highest that we'd seen since October 2023. On the local front, wholesale interest rates slipped back last week, but they are slightly higher than where they started the year. So our 5-year swap rate sitting at 3.7%. Right, let's run through the key releases from last week, and there were quite a few here in New Zealand. We got another housing market report from the Real Estate Institute. This covered the month of December, and it was fairly subdued, so it did reflect a soft finish to last year for the housing market. Volumes were down, as you'd expect when you go into that December holiday period. The days to sell sitting at 40 in Auckland, 42 elsewhere, and prices still quite soft. And the National House Price Index was down 0.7% for the month, and it was 1.1% lower through the calendar year. So house prices are down a little bit in 2024. National values are still 2.9% higher than that May 2023 trough, which is almost 2 years ago now, but they're still 15.7% below that peak that we saw in 2021. Auckland was a little bit weaker than most. Prices fell more sharply in December in Auckland, and over the course of last year, Auckland prices were a bit softer than others. So still no signs of life really in the housing market here in New Zealand, but we are expecting things to pick up a little bit throughout 2025. Dairy prices have started the year solidly. There was a global dairy trade auction last week that saw prices rise 1.4%. There was a particularly good showing from whole milk powder, which is a really important commodity export for our farming sector. Prices there gained 5%. So after a very strong 2024, where the GDT index gained almost 20%, things have been steady so far this year, and prices are pretty close to 2.5-year highs. Remember that we saw Fonterra up their milk price forecast late last year. Their midpoint there is now sitting at $10. That would be the highest of all time and above that previous record of $9.30. So when you think about the New Zealand economy, still lots of things to worry about in terms of softness, in terms of difficult conditions, but the dairy sector is very much a bright spot with high prices and a low New Zealand dollar against the US dollar, which is a good recipe for New Zealand dairy farmers. The big release last week in New Zealand was the inflation report, the CPI for the December 2024 quarter, and it came in close to expectations. We saw slightly stronger tradables inflation, that's imported inflation, although that was offset by slightly weaker non-tradables inflation. At the headline level, the annual inflation rate unchanged at 2.2%. So that was a touch higher than Reserve Bank forecasts. I think they were picking 2.1%. But look, it's still the lowest we've seen since early 2021, still very close to that midpoint of the target band, which is 2%. And the good news is that you saw that non-tradables inflation, which has been quite troublesome and quite worrying, that slowed to an annual rate of 4.5%. Still too high, but the Reserve Bank expected it to come down to only 4.7. So it's come down a little bit more than expected, and it's sitting at the lowest level in more than 3 years. So what does that mean for the OCR? We've got a meeting next month, and I think you'll still get that 50 basis point cut, and the market is expecting that too. That would take the OCR to 3.75%. Beyond that, we're expecting a couple more cuts, and it's expected to finish the year at 3% or 3.25%, depending on who you ask. So I think this inflation report doesn't change the landscape for the Reserve Bank. They'll be quite happy. They'll look at that non-tradables inflation and be quite comfortable where things are headed. 2.2% under control, close to the midpoint. You'll get that 50 basis point cut in mid-February, and that will be good for economic activity here in NZ. Elsewhere, we saw some global flash PMIs last week. PMI stands for Purchasing Managers Index. These are essentially activity indicators. I really like these as an economic indicator because we get them in a very timely manner. So what we saw last week were the flash PMIs for January. So very up to the minute, one of the first releases that we've seen for 2025. And they pointed to a solid start to the year for the global economy. Generally, they improved from a month earlier, which does suggest that the global economy has began the year on a sound footing. So all the major regions were above that break-even 50 level, which implies expansion, and the PMIs for Europe, Japan, Australia, and the UK all rose to 3 to 5 month highs, which is good news. In the US, activity did soften a little bit. However, the PMI remained very solid at 52.4, and pleasingly, we saw a return to growth in the US manufacturing sector. And it's the first time we've seen that in 6 months, which is good news. On the central bank front, we saw the Bank of Japan last week increase interest rates for the third time this cycle. That 0.25% hike sees the policy rate at 0.5%, 0.5%. Not much at all, but that's actually the highest we've seen in Japan since 2008. Remember that they had negative interest rates for 8 years, and they only just changed that in the middle of last year when they started increasing interest rates and brought them back into positive territory. You might recall we saw a lot of volatility in July last year after the Bank of Japan increased interest rates, and markets didn't take that well. In contrast, there was very little fanfare after last week's move, with the BOJ making sure that markets knew that was coming. It probably won't be the last rate hike from the BOJ. There'll be at least one more this year, one more 0.25% hike, maybe two, depends how things play out. So I think the policy rate in Japan will finish this year at 0.75%, maybe 1%. Still much lower than other parts of the world, but that's much higher than we've seen in a long time in Japan. Right, turning to this week, the final week of January, and it will be a busy one. There's lots to keep an eye on. Central banks will be in focus. We'll have the Federal Reserve in the US and the European Central Bank making decisions. So the highlight will absolutely be the Fed. Their decision will be released on Thursday morning here in New Zealand at 8 a.m. And they're expected to pause, which is really interesting. The Fed funds rate, the upper bound of that range, because they do a range, remember, not just a rate, the upper bound of that Fed funds rate range is sitting at 4.5%. That's down from a peak of 5.5%, and markets are expecting a pause because you've got a solid economy, the data's been good, people are worried and wondering about what will happen with tariffs and what does that mean for inflation, and a few other things up in the air as well. So the Fed is expected to slow the pace of its easing from here. They have cut rates by 1%, 4% from where they were at, but from here on they're expected to go a little bit slower. So expecting a pause this week, and then the next cut will probably come in May, maybe June, and just 2 cuts this year, just 0.25% cuts, which would see the Fed funds rate end the year at 4%, which is above the long-term estimate of 3%. That's what the Fed's got in its figures as a long-term estimate. So really interesting that they will choose to pause while we're still cutting. So that will be the focal point. That's on Thursday morning. We won't get a summary of economic projections. You will get a lot of talk and discussion about whether it's good or bad for markets with the Fed pausing, going a bit slower. I'm taking the glass half full view there because I think it's really important to remember that the US economy is in pretty good shape. Unemployment is falling unexpectedly. Job creation has been solid and things don't look too bad. Just look at some of those earnings releases that you're seeing come out of the US. The economy is in good shape. So you've got to take the good with the bad. You can't have a central bank that is slashing interest rates aggressively when things are actually looking pretty robust. So that is, I think, something that we need to focus on. It's not all bad. Remember that one of the reasons that the Fed is going a little bit slower is that the economy is not in bad shape, and that's not something to get too upset about or certainly panic about if you're an investor. We'll also get the ECB, and they will cut. Their meeting is on Thursday evening, so you get the Fed on Thursday morning, the ECB on Thursday evening, New Zealand time. The ECB cut its policy rate 4 times last year, so it started the year at 4%, now they're at 3%. You've had 0.25% cuts. Inflation's still coming down. The annual inflation rate's sitting at 2.4% in December, largely under control, so markets are expecting another cut this week. That would take the policy rate to 2.75%, and the ECB, I think, will keep going. They are expected to cut their policy rate to about 2% over the second half of this year. Lots to watch on the data front. Globally as well, we'll get official PMIs out of China on Monday afternoon. I think 2:30 is when those are released. In the US, we'll get the latest PCE inflation report on Friday. And on Thursday, we'll get fourth quarter GDP reports out of both the US and Europe. Closer to home, it'll be a holiday-shortened week across the Tasman. Markets are closed on Monday for Australia Day, although keep a close eye on the December inflation report, which is out on Wednesday afternoon in Australia. If that comes in as expected and you see another moderation in inflation, I think that will open the door for an RBA rate cut next month. And that would be really interesting because the RBA has held firm. They haven't been cutting interest rates like we have, like the Fed has, and like you've seen in the UK and Europe. They've just held firm because inflation has been too high. But I think this report could pave the way for that first RBA rate cut in February, as long as there are no nasty surprises. That would be very good for the Australian economy, and it would be good for the Australian share market if they can kick off that easing cycle next month. So Wednesday afternoon, that'll be the highlight in Australia. Here in New Zealand, it will also be a little bit quieter. Obviously, we'll have the absence of Australian investors because of their holiday, and that always means our market is much quieter. You've also got Auckland Anniversary Day on Monday, so much of the North Island will be on holiday. It's not a public holiday for everyone, so the market will still be open, it'll still be trading, but it'll definitely be a lot quieter. A couple of things to watch though this week in New Zealand. RBNZ Chief Economist Paul Conway is giving a speech on Wednesday, 11 o'clock I think it is. This will be a highlight ahead of that OCR decision next month. It'll cover New Zealand's longer-term economic growth potential, and he's expected to also talk about the neutral interest rate. And that's not important for next month's decision because that looks to be very much a done deal with that 50 basis point cut, but it is really important in terms of where the OCR ultimately settles this cycle. So as I mentioned earlier, the markets see the OCR falling to 3%, 3.25% over the course of this year, and they see that as the bottom this cycle, and that would be a little higher than we've seen in recent times. In recent years, we've seen the OCR end up lower than that, certainly during the COVID period, but even pre-COVID, I think it ended up at 1.75. So 3.25, certainly higher than we've seen over the last 10 years. So it'll be really interesting to see what Paul Conway has to say about where that neutral interest rate might be and how the Reserve Bank is thinking about it. So that'll be very closely watched on Wednesday morning. We've also got the latest ANZ Business Outlook survey. That is on Thursday. This has looked pretty good of late. We've seen confidence rise to a 10-year high over the last few months. I think it'll still look solid. Now, that doesn't mean that the economy is in fantastic shape. Remember, this is more a reflection of where businesses see things going over the next 3 months, 6 months, 12 months. And in that sense, there's a lot of optimism out there that 2025 will be a much better year than 2024 and probably 2023 and probably 2022 as well. And I agree with it. I think we will have a much better year this year, but important to note that we still haven't really seen evidence of that. It's on the horizon, but it's not right here on our doorstep as we speak. But that'll still be closely watched on Thursday afternoon at 1 p.m. Last but certainly not least, it will be a very busy week in terms of the international reporting season. That will be in full swing this week as companies report on the December 2024 quarter. It's been pretty good so far. We've seen about 16% of the US market report results, and 80% of companies have exceeded earnings forecasts. So at the moment, earnings growth has been tracking at about 12.5%, maybe 13%. That's the strongest we've seen in about 3 years. And 2025 is looking like we'll see earnings growth of maybe about 15% per annum, which would be up from about 10% in 2024. So that's one reason why the market's in good shape, because if you've got strong earnings coming through, then you're going to see strong share prices. If you put all of that other noise to one side, whether it's what the Fed's doing, whether it's inflation, whether it's politics, whether it's market sentiment, at the end of the day, the key driver of share prices will be earnings, and earnings is going in the right direction, which is why you've got pretty buoyant markets. This week is an important one. You'll have more than 100 S&P 500 companies reporting results, including 4 of the Magnificent 7. Microsoft, Meta, Tesla, they're all on Wednesday in the US, so we'll get those results on Thursday our time, and then a day later you've got Apple, Thursday in the US, so that'll be Friday our time. Those 4 make up about 17 or 18% of the market in terms of their size, so really important companies. Other US highlights will include Lockheed Martin, Starbucks, Caterpillar, Colgate-Palmolive, ExxonMobil, Chevron, so something for everyone this week in terms of earnings. Across the Atlantic, there'll be plenty going on too. It's not just the US reporting season, it's very much the global reporting season. In Europe, we'll hear from LVMH and SAP, so that's the first and the third largest stocks in the main index over in Europe, the Stoxx 600. So a very busy week with lots going on. You've got a Fed meeting, you've got an ECB meeting, you've got a ton of results, including 4 of those heavyweights, 4 of the Magnificent 7 companies. You've got some Chinese economic data, you've got a Reserve Bank speech, you've got a crucial inflation report across the Tasman that will be an important factor in what we see from the Reserve Bank of Australia this year. So thanks for listening. Enjoy your week, and we'll talk again soon.
For more insights, visit craigsip.com.